Hey, it's Jim, and this is level 3 of the CFA program, the topic on ethics and professional standards, and the super long reading on guidance for standards 1 through 7. Here we are today, standard 3, duties to clients, and don't forget the second part of that, and prospective clients. So we'll go ahead and start with loyalty, prudence, and care. Here are the LOSs, which are identical for all 7 of them. And here is the definition of loyalty, prudence, and care taken right out of the handbook. Duty of loyalty to their clients, reasonable care. But look at that last bolded point down there. Act for the benefit of their clients. And so this is the important emphasis in this part of the reading. Benefit of their client. And so place the client's interest before their employers or their own interests. So let's go ahead and start with a sample question here. This is an obvious one, I think. Which statement about the manager's use of brokerage commission violates the code and standards? A client may direct a manager to use that client's brokerage commissions to purchase goods and services for that client. All right, so let me just go back here quickly, right? Act for the benefit of their clients with the client's interest. So part A, choice A looks like it's okay. Let's see, used to benefit the client and should be commensurate with the value of the brokerage services received. That sounds okay, right? Benefit the client. I mean, that's an obvious statement inside of that. How about this one? Client brokerage may be directed for the payment of the manager's operating expenses. Well, we probably don't like that one at all. So what was the question back there? Which violates the code? So part C is the violation. Now, under guidance, let me just remind you that there are highlights for each one of these. And as I've said in those previous recordings, that those are probably pretty good sources of questions. So let's look at the 5 highlights here under loyalty, prudence, and care. First of all, understanding what loyalty, prudence, and care means. Identifying the actual client, which we'll talk about here in just a second. Developing the client's portfolio. Soft commission policies, and then proxy voting. So notice that first bullet point, client's interest always come first. That makes perfect sense here. And the second bullet point is a good part of emphasis inside of this reading. Boy, the same prudence and judgment and care that would apply in the management and disposition of their own interest in similar circumstances. And so this is an easy kind of a model to say something like, all right, if I'm the client, or how about if we do this? You guys listen to my recordings for, level 1, level 2. I talk about my mother a lot. She's been gone for 14 years. So this is how I would pretend. I would say, all right, every one of my clients is my mother. Yeah. So that makes perfect sense. And that third bullet point there, regardless of the relationship between the members and candidates and their clients, of course, we're going to know some clients. Some clients might be a cousin. They might be our mother. They might be a friend that we went to school with. They might be somebody we play softball with. But then we might not know many of our clients, at least initially. And so we need to make certain that these client agreements are that we perform these in the best of our abilities. Yeah, here's that second part. What is the actual investment client? So if I come to you as my wealth manager, well, it's obvious that I'm your client. But suppose that we have some kind of an institutional client and it's a pension plan or a trust or a foundation or whatever it might be, then we need to worry about the beneficiaries. Here's the example question that I gave my students last semester on an exam. I said something like, suppose that you have a client who is 100 years old, and he or she is wheeled into your office on a gurney with oxygen masks and all sorts of stuff attached to the client, and there's a representative there, and they say, here's John. He has 20 minutes to live, and he wants you to manage his money. And so the question is, what's the time horizon for this particular client? But then, as it relates to this particular standard, is who is the actual client? I mean, think about it. You got 20 minutes to craft a policy statement for this client, risk and return objectives. I mean, you can't do all that in 20 minutes. So what you say is what did I say? His name was John. You say, hey, dude, who are you leaving all your money to? And he might say something like, well, I have 19 children. So I want to leave half to those 19 children. And the other half I'm leaving to a foundation over here. So you don't have to do it all in 20 minutes, but you want to sign that policy statement and get it in his will so that we don't have to go through probate or any of that other kind of stuff. So you're not managing that John's portfolio for 20 minutes to try to maximize the future value of his portfolio by the time he dies. You focus on the beneficiaries. And then, of course, a good multiple choice question is to say something like, all right, here's a scenario. Who is the client? And the correct answer is none, because there's maybe an index or a mandate. So here are two just quick examples of this. There's the planned beneficiaries if we're a pension fund, and then a mutual fund according to a specific mandate. Those are good examples there. Developing the client's portfolio. This is my favorite part here, because I can, like I regularly do, swing back to the policy statement. This is my favorite assignment in my undergraduate investments class. I make them put together an entire policy statement. So we go through all of the components, just like you guys are doing now. And so this is all part of loyalty, prudence, and care, in that we're putting together a reasonable document, a complete document, and an accurate document that reflects the client's risk and return objectives and aspirations and all that good stuff. But as it relates to the standard, we need to make certain that we make all investment decisions in the context of the entire portfolio, which means, and this is a great exam question, it means explicitly that we need to know, or at least we need to suspect with a high degree of accuracy, what that correlation coefficient is between and among all of the different asset classes inside of that portfolio. And what changes in those allocations mean what their implications are to the rest of the portfolio. Soft dollar policies, there are just 2 paragraphs inside of the handbook here that address these. So I'm going to give you just a quick example. I'm a wealth manager. You guys are my clients. And so you come to me and send me all of your money. And I put together your policy statement. I put together your strategic asset allocation, and then it's my job to go ahead and execute all of those trades. Well, I mean, think about it. What I could do is I could just get in my car and drive to the New York Stock Exchange and walk in there and try to buy 100 shares of Procter & Gamble, but that sounds like a crazy idea. So I'm going to hire somebody to do that. So let's suppose I hire this investment firm over there, and just for simplicity's sake, suppose I pay them $100 for to trade and to put together and execute all of the trades for your portfolio. 80 of those dollars goes to their costs, right? Commissions, fees, whatever you want to call it. But $20 is like an extra premium. It's extra compensation that I pay them because it gives me access to some of their services or research or technology. So let's take 2 extreme examples. I mean, suppose that extra $20 gives me direct access to some kind of an optimization model. So I have access to that, and I'm willing to pay that $20 because you guys are going to benefit, right? You'll benefit from the use of their model, so that's a good thing, right? But what if I use that $20 to have access to some kind of technology that gives me the ability to buy season tickets to the New York Jets football game or something like that? Well, then I'm using that $20 to benefit myself. So that clearly is a violation. So remember now, we can pay the $20 as long as it, well, what have I said earlier? Benefits the clients, right? So that was one paragraph inside of the handbook. The next paragraph is that some of you might come to me and say, you know what, I agree with all your asset allocation and security selection decisions, but what I want you to do is I want you to take my capital and I want you to execute these trades over there with my brother-in-law, Ted. So I call Ted and I find out that Ted, he's charging some massive price. So, what's the deal? Well, I need to come back to you and say, look, over here, there's Renee and she can do a much better job. Ted is charging a higher price. So we need to make sure that, I need to make sure that I educate you. And you may insist and say, you know what, Ted, he's a great guy over there. He lets us use his lake house in the summertime. So I want you to do it, right? So that's fine. As long as the client knows that Renee is over there. So that's okay. So these are great questions where under one scenario, it is a violation. And under a different scenario, it is not a violation. Yeah, this is an interesting concept here about proxy voting. Back in the old days when I first was in graduate school, and when I was working on my MS in finance, we had this conversation about proxy because I had some great professors back then. And I left that program thinking that, it's the job of the mutual fund manager to vote every single one of those shares on behalf of their shareholders. But then in going through the CFA program, I learned that, there's a difference between having an economic value to the client and having no value to the client, right? So these are the good exam questions, and that's probably going to be some key sentence or phrase inside of the question stem, an economic value. So look for economic value or a likely substitute or no economic value. But look at the second diamond point there. Remember, we need to do lots of monitoring and lots of disclosing, always, and forever. All right, so how about some recommended procedures? So, of course, we need to submit some kind of statements regularly. Lots of people do it monthly, at least quarterly. That's what the Institute wants us to do. Make certain that we inform the clients where their assets are located. Are they put over there in this bank vault? Or are they put over here in my back seat of my car? Wherever they are, we need to make sure that the clients know where they are. Now, the back seat of my car, that's probably not a good choice. Not sure of the appropriate course of action. What would you do in this certain scenario? Well, if you have any kind of a doubt, just pick up the phone or send a text or an email, however you communicate with the client to say, okay, this is what we want to do. We want to put them over there. That makes sense. All right, so how about some policies on the responsibilities to the client? So diversify, that makes perfect sense. Carry out regular reviews. So this is all part of the monitoring. Deal fairly. So we'll have an entire standard on fair dealing. And then disclose conflicts of interest, compensation agreements. There's the proxies, maintain confidentiality, seek that best execution, and look at the bottom one there. Of course, place client interests above everything else. So let's go ahead and end Standard 3A with another good question here. We're a financial advisor. A portion of management fees comes from trading commissions. Engaging in excessive trading, boy, that doesn't sound good at all, right? Even though the trades are appropriate and aligned with their asset allocation. So what would be a trade that is appropriate and aligned with their asset allocation? So think about this. Let's just suppose that we have allocation, whatever it is, to the retail sector. And we have, let's just pick a number, 100 shares of Walmart and 100 shares of Target. So we do this excessive trading. And so maybe we sell 10 shares of Walmart and buy 10 shares of Target or vice versa. But, within that, 90, 100, or 110, that's within our strategic asset allocation range. But that trading activity goes beyond what is necessary. Yes. So is there a violation? Notice we have two no's and a yes. Well, yes, because he uses the client's assets to benefit himself. The excessive trading. Just because it's within the client's allocations, that's not in the best interest of the client. And just because they're authority, that's not in the best interest. So there's the correct answer there. Yes. All right, how about fair dealing here? Deal fairly and objectively with all clients. I just mentioned this a moment ago. What does that mean? That means that we have to have a blindfold on, right? Somewhere in the United States we have, the person with the statue with the blindfold on that says justice is blind. So that's pretty appropriate for our kinds of decisions that we're going to make. There are two highlights here under fair dealing. They have to do with investment recommendations and investment actions. So let's go ahead and start with a good problem here. A research analyst decides to change his recommendation from a buy to a sell. Now, as you're reading this, what you should be thinking is, all right, the next sentence ought to say something like, here are a bunch of reasons why we make this change. But in this short question stem, we're not told if we performed our due diligence or if we did not. So let's just take that as, something out there to look for in a potential question. He mails this change in investment advice to all the firm's clients on Wednesday. All right, so mailing, this must mean that we put in an envelope. You guys, are you old enough to know that there are envelopes and you have to address them and put a stamp on, put them in the mail? Anyway, that was a bad joke, of course. So who mails stuff anymore? I don't know. Some people do. So here we mail this out in what's known as the snail mail. So the day after the mailing, which of course implies that the post office is not super quick. So they're not going to get it into the mailboxes during the course of that next day. I can't help but refer to Newman on Seinfeld here, thinking about the United States Postal Service. All right, so the next day, a client calls with a buy order. All right, so what should we do if we have this buy order on a Thursday? So A, accept the order. Well, that doesn't sound like fair dealing, right? So that client doesn't know that we have made this change in our recommendation. All right, so advise the customer of the change in recommendation. That makes a lot of sense. Not accept the order. Well, we're not going to not accept the order, right? So part B sounds like the best answer there. All right, how about some guidance on here for investment recommendations? That's the first highlight. Yeah, fair chance to act on every recommendation. So what does this mean? If we put this in the old snail mail like the old days, well, that provides us with lots and lots of obstacles because we know that Newman doesn't deliver the mail on time. So what does this mean? We need to make certain that we get this change and recommendation out there as quickly as possible. You can use social media, we can put it on our firm's webpage, we can do whatever it takes to get it out there as quickly as possible. For investment action, so at the actual trading here, we need to make certain that we treat all clients fairly. Now, that doesn't mean that we treat all clients the same, right? I mean, some clients, let's go back to my example, might be perfectly happy and it's consistent with their risk and return objectives to have 90 or 100 or 110 shares in Walmart and Target. But another client over here, the retail sector, might be totally inappropriate. So just because we do something for one client with Target and Walmart doesn't mean we have to do the same thing, right? So fairly means that we consider everything that we've thrown together inside of that policy statement, which means that there should be no disadvantaged clients, especially during initial public offerings and seasoned equity offerings. Look at the bottom bullet point there. What is the Institute like? They like us to monitor, they like us to disclose, they like us just to make sure everybody knows the rules. Recommended procedures. So notice in the illustration over there, we've got compliance in that cloud in the middle. So what do we need to do? We need to have rules, we need to have standards, we need to have governance, we need to have all of these things as part of our compliance procedure so that we can deal fairly with each one of our clients. It might not be a bad idea for you to take a picture of that little illustration over there to add it to all the pictures that you have. Let's finish up fair dealing with a question. Here we go. CFO of Astra Capital specializes in corporate advising and capital raising activities. All right, so think about all of the conversations that we had back in our corporate finance. This means everything on the right-hand side of the balance sheet. So we have a client looking for an initial public offering, overwhelming amount of expression of interest from retail and institutional investors. It's oversubscribed. So what this dude does is remove all shares allocated to fee-paying family member accounts. I mean, I'm guessing that we remove those because it removes the appearance of a lack of fair dealing. So is this a violation of the fair dealing? So notice we have 2 no's and 1 yes. Increase the allocation to other clients. No, because he was prioritizing his clients' accounts over his family member accounts. Yeah, I'm not sure I like either one of those. Yes, because fee-paying family accounts should be treated the same way, of course, right? Just because we're related to that person over there doesn't mean that we don't need to consider them as part of the overall and overarching models of our clients. All right, suitability. This is a point of emphasis from the very beginning of level 1 in the context of the policy statement. And so, look at part A and B and C. What words are you reading in there? Client or prospective clients, investment experience, risk and return objectives, constraints, all of the extra work that we do, like a macroeconomic analysis and an industry analysis and sector analysis, deciding whether alternative investments are appropriate in there, right? So suitable, that's a great word here, the suitability of this. And once again, notice the part C was an emphasis of a point that I made just a minute or 2 ago, context of the client's total portfolio. Remember, I have made that conversation about the correlation coefficients. Yeah, specific mandate, strategy, or style. So this is probably more appropriate for mutual fund managers or managers of foundations or pension funds if they have a mandate there. All right, let's end this with an example question. Works for an investment counseling firm. Green meets with Brown for the first time. Used to be with another firm, switched her account to Brown's firm. After a few minutes getting acquainted. All right, so that's the signal right there. After a few minutes of getting acquainted, comma, the correct response is that we shouldn't be doing anything. We should be doing extra work on the risk and return objectives and all that other stuff that goes into the policy statement. So you shouldn't really do anything after a few minutes other than continue to get acquainted for way longer than just a few minutes. All right, a highly undervalued stock. Large potential gain. She recommends that Green purchase the stock. So, boy, after a few minutes, this goes back to what I was saying. What was that old dude? His name was John, right? Wheeled in. Boy, after a few minutes, we really don't know anything about this client. All right, so notice the last sentence. Brown has committed a violation of the standards. What should she have done differently? She should have determined needs, objectives, and tolerance for risk. I mean, that makes perfect sense. Should have thoroughly explained the characteristics of the company. Boy, if you launch into that after a few minutes of getting acquainted with the client, I'm guessing the client ought to just get up and walk out, right? And then explain education, training, and experience. Well, I mean, that's okay. That's okay, but that really doesn't allow us to go ahead and say this stock is suitable when it's probably not, right? All right, so what should she have done differently? Right, determine needs, objectives. So that's an obvious notion there. Let's move on to the highlights under Standard 3C Suitability. And let me just quickly go through these, and then I'll come back to this slide. Notice that there are 6 of them. So developing an investment policy, client's risk profile, updating, diversification, unsolicited trading requests, and then index or a mandate. So recall what I say every time I talk about these highlights inside of the handbook, that these are great potential exam questions. All right, so developing an investment policy. This goes all the way back to the very beginning of level 1. The policy statement. So what do we start with? We start with collecting client information to start that relationship, and then we move on from there. Let me just go back quickly here. What did we do? A few minutes getting acquainted. That is completely inappropriate and a violation. So we need to spend more than just a few minutes collecting client information. And then we move on to the meat of the policy statement, right? We need to say something like, all right, you have all of these financial constraints. What are we going to do within the context of those constraints? So we put together a return objective and we put together a risk objective. And remember that in general, in finance, what we're trying to do is maximize end of period wealth. Now, the problem inside of the policy statement as it relates to things like, risk preferences is that the client might have multiple stages, multiple future values during the course of his or her lifetime. If we have a client who just had a couple of children in the last year or two, so what do we have? We have one time frame where when they're 18, they want to go to college, but then we have another time frame of, let's say, 30 years when we retire, and then we have another time frame when we die. So this is all part of the artistry of putting together a policy statement. Yeah, updating the investment policy statement. Of course, the Institute recommends to do this under 2 scenarios, at least annually, and then when there are significant changes. And those, of course, significant changes are when we have more children, when we have to take care of a parent, when we move from the 39% tax bracket down to the 15% tax bracket, if we have health issues, et cetera, et cetera. Diversification, you probably don't need me to remind you of this. You probably don't need the Institute to remind you about the need for diversification. Let me just give you some quick statistics. There have been tons and tons of studies over the years that show that the average standard deviation of a randomly selected share of stock on any of the U.S. stock exchanges is somewhere around 50%. The average standard deviation of a well-diversified portfolio, let's say the S&P 500 or the Wilshire 500 index, is somewhere around 15 or 18 or 19%. So just by investing in a diversified portfolio without having any knowledge of any of this stuff that the Institute is teaching us, we can dramatically reduce standard deviation. Of course, you're not going to explain standard deviation to your client. I mean, you might if the client has some kind of a background, but every client understands volatility. Unsolicited trading request. Yeah, so every once in a while you're going to have a client that comes to you and says, oh, I just read in some magazine over here that this company, let's call it Jim's Concrete Company over there. Boy, I heard that Jim, he's a really, really smart guy. He knows how to pour concrete. His stock price is only $10 a share. I want to load up on that because I think it's going to be $100 a share by the end of the week. Boy, you just have to scratch your head. And so what does the Institute want us to do? The Institute wants us to say something like, oh, let's go investigate Jim's Concrete Company. Let's see if it matches up with the client's portfolio. Maybe it does. Maybe it doesn't. So this goes back to the suitability for the client. Managing an index. So what does this mean? If I'm a fund manager and I say I'm going to invest in the exact same percentages of the 500 stocks in the S&P 500 index, well, then that's what I'm going to do. And if I want to add Jim's Concrete Company to that, Jim's not a member of the part of the S&P 500 index, well, then that would be a violation of the index. All right, so recommended procedures here. A written IPS, that makes perfect sense. Periodic review of the client's policy statement. Suitability test. Yeah, that makes lots of sense. All right, let's end with a question here. Travis Green, portfolio manager. High growth fund. All right, so what do you think about when you think of a high growth fund? You probably don't think of the Pennsylvania Water Company, but you might think of the Pennsylvania Technology Company, right? All right, he purchases high income, notice in parentheses, we're getting the signal, low growth stocks of several utility firms. He believes that these stocks are significantly undervalued and would provide a positive return for the fund. If he purchases these, is this a violation? Yes, because he is not following the investment mandate. That makes perfect sense. Let's see, discretion of the fund stock selection. Well, that could be true, and he can have discretion, but he has to have discretion in the context of high growth securities. No, because the potential upside, well, we don't like that answer because we can always be wrong, right? Yeah, so there's the correct answer, yes. All right, how about performance presentation? This is an interesting standard D because the handbook has no highlights in here. So I'll go ahead and try to establish a highlight here, and I'm just going to plagiarize right off of the first sentence in the handbook inside of this section where the institute uses the word credible. Provide credible performance information to the client. So there's Jim's highlight here, even though there is no formal highlight in this section. But what are some words other than credible? Fair, accurate, and complete. That makes perfect sense. So let's go ahead and look at a good question here. Let's see. We've got a new very large account, 2 concentrated positions. The current policy is to add new accounts for the purpose of performance calculation after the first full month of management. All right, so what's important about that sentence there? The firm's current policy. So somebody in the firm established this policy, whether it was us as part of this management team, maybe it was the compliance department, maybe it was our chief risk officer, maybe it was just somebody over there who decided this was our current policy. So we're obligated to follow that current policy. So here we are responsible for calculating the performance returns. Before the end of the initial month, we noticed that one of the significant holdings is acquired by another company. Let me just remind you that the average takeover premium in the acquisition market is about 50%. So the value of this investment here it doubles. So that's 100%. So even if it doesn't double, still going to put lots and lots of, kind of inflated performance inside of this particular concentrated position. Let's see, what do? We decide to account for the new portfolio as the date of transfer rather than the end of the first 4 months to reap that positive impact. With regards to the code, which of the following is most likely correct? Let's see, we did not violate because the GIPS standards allow for composites to be updated. Well, that makes perfect sense, right? However, it violates our current policy. We did not violate because companies are allowed to determine, right? That makes perfect sense here. But what we did is we produced an inaccurate calculation of the monthly results. And so what is the most likely correct there? C is our correct answer. How about some guidance here, right? Do not misstate, do not misrepresent. Provide fair and complete. Let's go back to that word that I stole from this handbook, credible, right? Do not state or imply the ability to guarantee a return, even if you have done this similar return in the past. I mean, let's suppose I'm a fund manager and I've generated a 50% return every year for the last 10 years. Well, I can't guarantee that I'm going to put together 50% over the next year. All right, so apply GIPS. What you can do is you can comply without adopting GIPS, but what you need to do is you need to consider knowledge and sophistication of the audience. You need to put together weighted composites. You need to worry about terminated accounts. And then, of course, the Institute wants us to monitor and disclose. We hear about that all the time. All right, let's end this with another good question. Well-respected fund manager impressed. Let's see, the partners are impressed by the performance, consistently outperformed. They successfully hire her away, sends out marketing material created by Jensen, stating her performance history and uploading her performance information on the company's website. In her biography, she discloses that her performance history occurred at her previous firm. Still, she doesn't disclose the years she underperformed in the stated benchmark. All right, so what does this say? This says to us that, all right, everything sounds to me like it's okay up until the point of omission, right? So did she violate? No, because she does not need to disclose her years of underperformance. Well, that doesn't sound like anything that we've talked about over the last few minutes. No, because she disclosed that her performance occurred at her previous employer. I mean, that's a perfectly fine sentence, but it still doesn't forgive us for this violation. Yes, she is selective. So, of course, the correct answer is C. She is selective. So what was that? We need credible. Yeah, we need complete, right? We need accurate. All right, how about preservation of confidentiality? Of course, the Institute wants us to monitor and disclose, and they want to make sure that whatever client information we have, we put it in the box, and we put that box in a safe spot. We don't put it in the back seat of our car, to refer to an example that I used just a little bit ago. Keep information about current, former, and prospective clients confidential. Now, there are some exceptions. All right, illegal activities, disclosures required by law, or if the client says, you know what, I don't really care who knows about all of my stuff. Let's go ahead and start with a good question here. Appointed board of directors of a youth golf program. All right, it's a local chapter of a national not-for-profit organization. All right. We're beginning a new fundraising campaign, expand the number of annual scholarships, believes her clients make annual donations to the charity. All right, so think about this. You have you've got this not-for-profit, and you have Joshua, who holds the charter, and Joshua has these clients, right? Now, she includes a small section in discussing the fundraising campaign and her position on the organization's board. So which of the following statements is most likely correct? All right, so Townsend did not violate the code. She violated the code by soliciting donations. She violated the code by not getting approval of the organization before soliciting the clients. Well, does she need to have that? Here, whoops. Let's go back. Does she need to have approval from the organization? I don't know. I mean, that sounds like it might be reasonable, but that's probably not part of this preservation of confidentiality because of the coexistence of all of this thing. And clearly it doesn't sound like she's fundraising. She just, what does it say? Small section discussing the fundraising campaign and her position on the board. So if there were a sentence in there that said something like, how about if you send me $10,000 before I update your policy statement next week? You know, that doesn't sound like something that we would like. All right, how about some guidance here? Avoid sharing client information. Yeah, exam tip. All standards extend to former clients as well, right? Cooperate with any investigation by the professional conduct program. And by the way, you know, I wonder if any of you guys do this. I think I probably mentioned this all the way back in my level 1 recording. You can always go to the CFA Institute's webpage and you can see the current and historical investigations. And, you know, when I read through these investigations, I mean, they're just sad. I'm thinking, you know what, why do we violate some of these things? Why are our colleagues, why are they getting their designation taken away from them? I'm wondering, you know, it's clearly not worth it to study for the exam, but, you know, just go to the webpage there and just click on one or two of them and just see, all right, how do people lose their privilege of using this amazing CFA designation? All right, recommended procedures. Let's see. Refrain from disclosing client except to approved employees. Yeah, comply with electronic communications, and then prevent accidental dissemination of client information. Remember on that last recording, we had an example where an analyst was having a conference call in his or her office, and then some of his or her colleagues walked in and they heard about a merger or an acquisition or some dramatic potential change in the stock price. This is when we were talking about material and non-public information. So this is kind of like the same thing. You wouldn't want one of your colleagues to walk in during a meeting with a client and your client says something like, oh, you know what, I have this and this and this, right? So accidental dissemination of client information. And of course, a great exam question is, all right, suppose that we collect this information and we hire a third party to store it. So we need to perform our due diligence and make sure that our third party is conforming to all of our standards of confidentiality. All right, how about we finish up with another question here. Manages the investment portfolio of a wealthy businessman. Carlo, he's under informal investigation, suspected illegal drug activity, large increases of money. Carlo doesn't tell us where it comes from. What's the most appropriate course of action for us to comply? Let's see. We should disclose any information that could assist in their investigation to the relevant authorities. Maintain client confidentiality in all instances. Well, remember back there we had that one slide where it said something about, we need to pay attention to the law and the authorities. And then we should consult the firm's compliance department to determine the relevant policies. All right, so we're going to disclose any information. Boy, that part A doesn't tell us, to the relevant authorities. So what answer do we like? We probably like C. I mean, A, you're kind of tempted to do that, but let's go ahead and talk to our compliance department beforehand. And that takes us through Standard 3, duties to clients and prospective clients. We'll switch gears on the next one. We'll talk about duties to employers. So thanks for watching and good luck studying. I'm going to go ahead and repeat this here. I shouldn't have to say this again, but I will. I want you to go to those 38 or 40 questions at the end of this super long reading, and I want you just to go through those again as quickly as you can. Don't worry about getting the correct answers, but I want you to read the question, read the potential answers, and so this is going to reinforce and reinforce. And then when we're done Standard 7, I'm going to have you go do this and take that as a practice exam. Anyway, thanks for watching. Have a great day.